Welcome to a new journey where we unlock the secrets of dividend investing. Let's kick things off by setting the stage with a brief introduction to our topic. Dividend investing, in its simplest form, is a strategy that focuses on buying stocks of companies that regularly pay dividends. Now you may be wondering, why is this such an interesting topic? Well, dividends are a portion of a company's earnings that are paid out to shareholders, which means they can provide a steady stream of income, in addition to any potential profits from selling the stocks at a higher price. Essentially, you're earning money while holding on to your investments. This makes dividend investing an attractive strategy, especially for those seeking financial stability. It's an arena where patience and strategic thinking can lead to significant financial rewards. So buckle up as we delve into the fascinating world of dividend investing. First, let's unravel the mystery of what dividend investing actually is. Imagine you're at a bustling farmer's market. You see a stall selling apple trees. Intrigued, you decide to buy one. You plant this apple tree in your backyard. Over time, the tree grows, and it starts producing juicy apples. You didn't have to do much, yet every season you get a fresh batch of apples from your tree. That's essentially dividend investing in a nutshell. In the world of finance, when you purchase shares of a company, you're essentially buying a tiny piece of that company, much like how you bought that apple tree. Companies that have been profitable often share a portion of their earnings back to their shareholders. These payments are known as dividends. The idea behind dividend investing is pretty straightforward. You invest in companies that regularly pay dividends, and over time, these dividends accumulate, providing you with a steady stream of income. It's like having an apple tree that reliably produces apples season after season. Dividend investing isn't about quick gains or sudden windfalls. It's about patience, consistency, and long-term growth. It's about choosing companies that have a history of paying dividends consistently and are likely to continue doing so in the future. It's not about buying the tree that grows the fastest, but rather the tree that will produce the most apples over its lifetime. The beauty of dividend investing is that it allows you to generate income without having to sell your shares. You're essentially earning money while still holding on to your piece of the company. It's like enjoying the apples from your tree without having to chop it down. And the best part, these dividends can be reinvested to buy more shares, which in turn can generate more dividends. It's a virtuous cycle that can lead to significant growth over time. It's like taking the seeds from your apples, planting more trees, and ending up with an entire orchard. So in essence, dividend investing is like planting a tree and reaping its fruits over time. Now you must be wondering, why should you consider dividend investing? Well, let's dive into the many advantages of this investment strategy to answer that very question. Firstly, dividend investing provides a steady stream of income. Companies that pay dividends are essentially sharing a portion of their profits with their shareholders. This means, as an investor, you get a regular payout, usually on a quarterly basis. This income can be a great addition to your regular salary, or even serve as a safety net in times of financial uncertainty. Secondly, let's talk about the magic of compounding. When you reinvest your dividends back into buying more shares, you're setting off a snowball effect. As you acquire more shares, you receive more dividends, allowing you to buy even more shares. This cycle of compounding can significantly boost your portfolio's value over time. Albert Einstein once famously said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." And this principle applies beautifully to dividend investing. Now, onto the third advantage, lower risk. Companies that regularly pay dividends are typically well established with a history of generating consistent profits. They're often less volatile compared to growth stocks, making them a safer bet in turbulent markets. So, if you're the type who prefers stability over roller coaster-like market swings, dividend investing might just be your cup of tea. Lastly, let's not forget the tax benefits. In many jurisdictions, dividends are taxed at a lower rate than regular income, leaving more money in your pocket at the end of the day. To sum it up, dividend investing offers steady income, the power of compounding, lower risk, and tax benefits. It's an investment strategy that not only rewards patient investors but also provides a measure of financial security that's hard to beat. With all these benefits, it's clear why dividend investing is a strategy worth considering. So, you're intrigued and want to start dividend investing, but where do you begin? Well, let's take a calming breath and delve into it, step by step. The first step towards dividend investing is, you guessed it, research. Yes, it might seem a bit daunting at first, but don't worry, it's not as complicated as it sounds. You'll want to look into companies that have a history of paying dividends. This is a good indicator that they value their shareholders and are likely to continue paying dividends in the future. Now, you might be wondering, how do I find these companies? Well, many online platforms can help you with that. Websites like Yahoo Finance and Google Finance provide comprehensive information about a company's dividend history. Remember, it's not always about the highest dividend yield. Sometimes, a company with a moderate but consistent dividend payout can be a better choice. Moving on to the second step, choosing the right companies. This is a critical stage in your dividend investing journey. You have to be smart and strategic. Go for companies that are not only profitable, but also have a solid track record of stability and growth. These companies are more likely to sustain their dividend payments and might even increase them over time. However, it's essential to diversify your portfolio. Don't put all your eggs in one basket. Investing in different sectors can help you mitigate risks. For instance, if one industry is not doing well, you might still earn dividends from other sectors. The third step is reinvesting dividends. Now this is where the magic happens. When you receive dividends, you can choose to spend them, or you can reinvest them to buy more shares. This is known as a dividend reinvestment plan, or DRIP for short. Reinvesting your dividends allows you to leverage the power of compound interest. Over time, this can lead to exponential growth in your investment. Finally, be patient. Dividend investing is a long-term strategy. It's not about getting rich quick. It's about creating a steady stream of income that can support you in the future. So, don't be disheartened if you don't see immediate results. Remember, the tortoise won the race, not the hare. In conclusion, starting dividend investing is a journey that involves research, choosing the right companies, and reinvesting dividends. It's a strategy for the patient and the disciplined. It's not always glamorous, but the potential rewards can be significant. With these steps, you're well on your way to becoming a successful dividend investor. However, like any investment strategy, dividend investing isn't without pitfalls. Let's dive into some of the common mistakes investors often make in the realm of dividend investing. First on the list is the classic blunder of chasing high yields. It's a tempting trap seeing a company with a high dividend yield and thinking, wow, that's a lot of cash. But remember, a high yield might be a red flag signaling financial instability. Companies with high yields might be stretching themselves thin, and those juicy dividends could be cut in the blink of an eye. Next up, ignoring company fundamentals. Dividends aren't conjured out of thin air, they're paid out of a company's earnings. If a company isn't profitable, or if its business model is shaky, those dividends could dry up. So before you invest, take a good, hard look at the company's balance sheet, its earnings reports, and its future prospects. Make sure the company is fundamentally sound. Finally, there's the mistake of not diversifying. We've all heard the saying, don't put all your eggs in one basket, right? Well, that applies to dividend investing too. If you invest all your money in one company or even one sector, you're exposing yourself to a lot of risk. What happens if that company or sector tanks? You could lose a big chunk of your investment. So, spread your investments across different companies and sectors. This way, if one investment goes south, you've got others to cushion the fall. These are just a few of the common mistakes people make when it comes to dividend investing. But by being aware of these pitfalls, you can avoid them and set yourself up for success. Investing is about more than just picking stocks and hoping for the best. It's about strategy, knowledge, and understanding the risks involved. And when it comes to dividend investing, avoiding these common mistakes is a big part of that. By avoiding these mistakes, you can maximize your dividends and minimize risks. Now, how does dividend investing stack up against other investment strategies? Well, let's take a look. Dividend investing, growth investing, and value investing are all strategies used by investors worldwide, each with its unique approach and potential benefits. Let's start with growth investing. This strategy involves investing in companies that are expected to grow at an above-average rate compared to other companies in the market. The idea here is to capitalize on the company's future earnings and price appreciation. However, growth investing can be risky as these companies may not always live up to their high expectations. Dividend investing, on the other hand, provides a steady income stream which can be particularly appealing in volatile markets. Now let's move on to value investing. Value investors seek out companies that they believe are undervalued by the market. They're like bargain hunters, looking for stocks that are trading for less than their intrinsic values. While this approach can certainly pay off, it requires a good deal of research and patience. In contrast, dividend investing can be a bit more straightforward. You're essentially looking for companies with a history of paying out reliable dividends. So, where does dividend investing fit into your overall portfolio? Well, it can serve as a solid foundation. Dividends can provide a steady stream of income, which can be reinvested to purchase more shares, creating a compounding effect. This can be especially beneficial during market downturns, as you're essentially buying more shares at lower prices. However, it's important to remember that no investment strategy is perfect. Each comes with its own set of risks and rewards. A balanced portfolio often includes a mix of these strategies, tailored to the individual investor's goals, risk tolerance, and investment horizon. As you can see, dividend investing has its unique place in the investment world. It's a strategy that focuses on steady income and potential for compounding, making it a worthy consideration for any investor. We've covered a lot of ground today, from understanding what dividend investing is to how to get started. We dove into the world of dividends, dissecting the concept and shedding light on its many facets. Remember, dividend investing is all about earning a steady stream of income from your investments. It's a strategy that focuses on companies that share their profits with shareholders, which can be a great source of passive income. We also highlighted the numerous advantages of dividend investing. It's a strategy that can offer you a consistent income, potential for capital appreciation, and a hedge against inflation. Moreover, it can provide a layer of protection in volatile markets, as dividend-paying companies are often more stable and established. Then we took a step-by-step journey on how to get started with dividend investing. We explored the importance of doing your research, understanding a company's dividend history, and considering the payout ratio. We emphasized the significance of diversification and the need to reinvest your dividends for compounded growth. We didn't shy away from addressing the common mistakes in dividend investing either. Chasing high-yield stocks without considering the company's financial health, or overlooking the impact of taxes on your dividends are pitfalls to be aware of. And finally, we compared dividend investing with other investment strategies. While every strategy has its merits and demerits, dividend investing stands out for its potential to provide a steady income and long-term growth. Dividend investing isn't just a strategy, it's a journey towards financial independence. It's about making your money work for you, even when you're not actively working. It's a path that requires patience, diligence, and a keen eye for quality investments. But with time and effort, it can lead to a stream of income that grows over time, helping you build wealth and secure your financial future. Thank you for joining us on this journey into dividend investing. If you enjoyed this video and want to learn more about investing, please don't forget to subscribe.